All right, investors have lost close to 11 lakh crore rupees in the last 7 trading sessions. But a closer look at the numbers reveals that retail investors have been reducing their stake in equities for the last 2 quarters. Retail investors have kept Indian equities insulated from selling pressure when FIIs reduced their stake in recent times. But now the sentiments seem to have changed due to various factors. Muted market returns are the big question among retail investors, and they're wondering whether they should continue their SIP contributions or lock in their hard-earned money in fixed instruments, where the rates seem to be quite attractive with specific and continuous rate hikes. So why are retail investors spooked, and what next for them? To speak on this, I'm joined today by Abhishek Basumalik, Chief Equity Advisor at Intel Sense Capital. Pankaj Murarka, CIO at Renaissance Investment Managers, is with me on the show today. And I'm also speaking with Sandeep Bagla, CEO at Trust Mutual Fund. Welcome to all of you, and thank you so much for speaking with us. Pankaj, let me begin with your take really on what we've seen with retail investors. The data that is coming in is trading volumes essentially on the cash market, which have been sluggish, a little more on the equity side. SIP inflows have been fine, but mutual funds are also sitting on a fair amount of cash. What is the picture that you are seeing as far as retail investors and that whole buzz of retail investors is concerned, including the new entrants post-pandemic?
Well, Tamanna, whatever I'm seeing is no different than what I've seen over the last 25 years. We need to bear in mind the context. Just think about it. Pre-COVID, we had about 10 million investors unique investors into Indian equity markets. Over the last 3 years, that unique investor number has gone to 40 million. So essentially, that number has gone 4x. And a lot of these are first-time investors who haven't experienced a bear market as yet, because equity markets have been into a very strong bull market post-pandemic over the last 2.5 years. So I think what we're essentially witnessing is some sort of a healthy consolidation as far as equity markets are concerned over the last 6 or 9 months, which is very healthy for the long-term outlook for markets. And I think obviously some of these investors who came to the party and had a Merry Christmas, in the sense they had a great time, making money in the short term. Obviously, some of those investors might have pulled back in that sense. And I don't feel too concerned about that, because I think over a period of time, these investors will go through their own investment cycle, will have their own experience, and probably will become much more matured equity investor over medium term to long term. I think the fact is...
a lot of, Pankaj, the fact is that a lot of these were first-time investors who discovered the markets literally working from home. This was a very different breed of people who came in. And like you said, it was a Christmas party for quite some time. The music has stopped. Some reality checks have come in. We've had big events in the last 1 month or so. You had the whole Hindenburg saga at the end of January, then post-budget, etc. We have quarterly numbers to look forward to. Do you think that a lot of them will stick around, or then realize that maybe there are other avenues? And also keep in mind better interest rates coming in on fixed assets and fixed deposit schemes.
Well, equity markets will be volatile, because that's the nature of the beast. At the end of the day, that is what equity markets are supposed to be, and that is how they are. All of us know, while fixed income can look compelling from a short-term or a medium-term perspective, but over a medium-term to long-term, returns on equities far exceed that of fixed income. So investors, my advice to these investors would be, one, they should get their asset allocation right in that sense, but fixed income will never be able to match equity returns over a longer period of time. More importantly, as you rightly pointed out, and the point I was trying to make was, these investors need to approach equity markets from a much more longer term perspective. And if they themselves are not professionally qualified or equipped to take investment decisions, probably they should take professional help, because equity markets will go through their own swings and cycles in that sense. And that's the nature of the beast, that if after every bull market, we have a bear market and vice versa. And I'm sure some of these investors might burn their fingers, and for a moment, they might just stay away from equity markets. But longer term, I still think that the base of equity investment in India is still too small in relation to what potential it has to be. So I don't feel too concerned about that, because I think what we essentially see over the last few years is education levels have improved significantly, and more investors will come to equity markets, because the fact remains that no other asset class can give returns which equities can give over medium to long term. So I don't think so investors have a choice with that.
Yeah, you have to take a long sort of term view and also be prepared for the reversal in the interest rate cycle as and when that comes. Abhishek, what are you seeing in terms of the mood for retail investors, retail equity investors, and that ever-long, everlasting debate is back on whether to continue your SIP contributions, remove that money, put it in a fixed deposit. What do you do? What's your take on all of that?
Yeah, I think, see, the mood right now is slightly more, circumspect than what we were seeing, say, a year or 2 years back. And that is very normal because what we see is retail investors tend to, jump in when things are good, and then they sort of try to go out when things are not going so well. That's been the nature of retail investors globally, and this time is no different. It's the same thing that's repeating again. And uh, last 1.5 years practically, since I think 2021 October, markets have been going sideways, so not too much returns to speak about. But if I look at the SIPs, uh, I think it's very, very important for investors to continue with their SIPs vis-a-vis when you look at fixed deposits. The simple reason is, I have never seen anyone create a lot of wealth by investing in fixed income. At most, you can protect your wealth. Whereas if you look around, what is it, or what is the structure that creates wealth? These are businesses. And when you are an investor, even if you are doing a SIP for maybe even 1,000 rupees, you are actually becoming maybe a 0.0001% uh, partner of a company, of a business. And that is the way to look at it. So the best time to do, or maybe even increase your SIP, is when the markets are going through a bad phase. So my take would always be that not only should investors continue with their SIPs, they should, if possible, maybe increase it over the next 6 months.
The time to actually dig your heels in and increase your SIP over the next 6 months. Sandeep Bagla, I assume you will definitely agree, but the kind of returns that mutual funds are giving to investors versus those who directly go into the equity markets on their own is also under a lot of scrutiny. And in this information age, the question is that, are you really getting your worth when you go through an intermediary like a mutual fund?
Tamanna, mutual funds actually employ the best in class fund managers at a very token fee of 1 or 2% per year. So it would be unfair to say that a person who's not really qualified and does not really know how to deal with the swings of the market will be able to outperform a professional fund manager for a long time. So the Indian investor has been a return chaser. We have seen it in real estate, we have seen it in gold, we have seen it in equities post the COVID or during the COVID. Then we saw it in cryptocurrencies and probably to an extent in NFTs also. Now, SIP is a very different category. It's a way of savings. It's not a way of trying to generate returns in the short term. So yes, there will be people who will opt out, who have not seen probably the cycles, and they have the last 7 years by and large have been a bullish kind of a market, and people have not seen negative returns. Come to think of it, the broad markets have not really fallen more than 10% from peak. So the correction has been fairly gradual and shallow. However, it's quite possible that individual portfolios, which have been based out of the flavor of the month, could have seen far more declines, far sharper declines. And I agree with everybody that, while this market can fall more, and probably because of inflation, because of interest rates going up, see, some amount of switching does happen. When interest rates are at 3-4%, you will find people looking at equities to generate returns. And when they go to 8-9%, then a lot of money would switch into fixed income assets. So while fixed income assets cannot make you very rich, but in bad times they can act as a buffer to protect your income so that when the markets start going up again, you are in a situation where you can again start investing.
So
I think
what would be your advice right now, Mr. Bagla, to people who are watching and saying that my SIPs have not really fired in the last year or so?
well, that's all right because you are perhaps in a working age where you are fairly young, you have entered the investment cycle and the investment markets, and you are going to probably save for next 20-30 years. So I agree that one should stay with the SIPs and probably also start increasing the SIPs by a certain percentage every year. So see, India is a growth economy. Whether markets may sometimes overshoot in their enthusiasm or because of money printing globally, but eventually we should do all right in terms of returns over long periods of time. The graphics that you are showing yourself show that in 5, 10, 15 years, the Nifty returns have been quite high in the range of maybe 10 to 14% annually. So I think unless that hypothesis is proven incorrect and the Indian market stops growing, we have to stay invested. However, one advice I would give that if people have lopsided asset allocations because the equity markets have gone up, you have tended to ignore the fixed income markets. It will be a good time to sort of look and carefully assess your risk appetite and reallocate some money to fixed income and balance it out. But the SIPs you must continue and you must increase the SIP amount whenever you can.
You spoke about a sort of reality check that retail investors are getting right now. And do you think that in the long term, that's actually a good thing to know that, this post-pandemic sort of froth that we were seeing in the markets is not a business as usual? Pankaj Murarka, that question's for you.
Sure, Tamanna. So I think my view is that despite all of these events that you highlighted, let's say the Heidelberg report and some geopolitical issues, the India story has only got stronger and better over the last year. And the fact remains that India is going to be probably the best performing economy over the next 15-20 years. Investors should look at equities and SIPs as their core asset allocation, something which they should remain committed to and keep doing it over the next 20-30 years of their life and park a meaningful part of their savings out there in Indian equities. And it should become a core asset class for investors. Having fully known the fact that it's a cyclical asset class, but the fact is over medium term to long term, it gives you returns which are far better than any other asset class. You look at the last 20 years, Nifty has averaged about 13.5% CAGR, and probably that's the best return that any other amongst all the other competing asset classes. So I think investors should not be too perturbed about short-term returns and volatilities in equity markets. They should take a much more medium-term, longer-term view on Indian equities. More importantly, equity allocation should be a core asset class, and they should just stay committed to that over a long period of time. And when it comes to savings and SIPs, as we always say, that the sooner you start, the better it is, and just stay the course. And obviously, a lot of these investors are doing DIY, doing it yourself. My sincere advice to them would be to take serious professional help, because at the end of the day, investing into equities does require some professional skills and maintain the discipline.
To add to that, you're talking about DIY. There is a lot of information there online as well, from finfluencers, people with their own YouTube channels, which has no check and balance on it. And that can become tricky terrain, especially at times like now. This is where the wheat gets separated from the chaff. You want to add to that, Pankaj?
Yeah, that's right, Tamanna, which is why I say that investors, when you're allocating a serious part of your savings to equity markets, one, you need to be disciplined, and secondly, you need to be careful. And which is why if you yourself don't have the expertise to decipher markets and do fundamental analysis of companies in which you're investing into, it's better to take professional help And as Sandeep was highlighting, in India, it's a very competitive mutual fund industry out there where investors can avail the services of best of the investment managers at a very low cost. I'm sure some of the points you highlighted in terms of data being out there or information being out there, I think regulator is keeping an eye on that, and I'm sure it's a matter of time before we see some regulations around that to regulate some of those information and data in terms of how it flows around. But having said that, I think investors will have to take care of themselves in that sense, buyer beware, and they should approach it more professionally because they are allocating serious part of their allocations there. And it'll be better off if they themselves don't have the skill set to take some professional help and advice.
Absolutely. Don't lose heart, don't lose hope, but also review, your investments in terms of not everything you touch is going to turn to gold anymore. It was not you that had the Midas touch. You were perhaps in the middle of a gold rush, which has now ebbed. So it's back to reality. Thank you so much to all of you for joining us on the chat today. Just